Pandora shares are down more than 20% in after hours. This comes after the third quarter results and the guidance that management gave for the fourth quarter, which missed expectations. We're going to take a look at the guidance and the one-time charges that management disclosed this quarter. We're going to plug them into our earnings model and determine if that 20% move makes sense or not. So as we go through this, we're going to be using our Pandora Media earnings model, and if you're new to our modeling approach, please visit our website, gutenbergresearch.com, click on the Models and Focus tab, and scroll down to Pandora, and this will explain how our model works, and you can also download the model from this page. The guidance is going to come from the Investor Relations page, and as we go through, as a point of reference, we have two models here. The model on the left-hand side of the screen represents our model that we had at the close today. This was a consensus-based model, as you can see, with these orange cells represent consensus estimates. And now on the right-hand side is the model after the update, so we'll be referring back and forth to these two. So going to we've already updated the September quarter for the actual results, and then let's go to the guidance and start there. So if you scroll down to the second page, you can see where they give additional details for the fourth quarter. So we're starting with revenue in the range of $325 million to $330 million. So we set it to the midpoint of that range. And if we go back to the earlier model, that's well below the consensus, was over $350 million. So revenue is definitely lower than what the street was expecting. Next we go to adjusted EBITDA, and just like before, we're going to hold off on the total adjusted EBITDA number and pick off the individual items that they give us. So they say it excludes forecasted stock-based compensation of approximately $32 million, so that's up $2 million from last quarter. And if you scroll down to the non-GAAP section, you'll see we disclose the stock-based comp, so we've input $32 million for the fourth quarter. Next is depreciation and amortization is expected to be $6 million, so we've input that into the model. Minimal provisions for income taxes, so we actually didn't change our rate of income tax, but it's not a significant impact here. So we have $54,000. That's on a GAAP basis. And then the share count is expected to be 24 million shares. I'm sorry, 224 million shares. We can update. Okay. Now, full year guidance, we'll come back to that. It's important to note here that this does not include Ticketfly's financial results, so obviously the deal was just disclosed earlier this month. We're not sure if it's going to close in the fourth quarter and if they'll be consolidating those results for the time being. Most analysts probably will not include those values in their fourth quarter estimates, so we're not going to either, and management hasn't. We have a little note here saying that that we're not including that, and management is not including that. This next note is just about the fact that they're making the tax adjustment on the non-GAAP adjustments. So that's not expected to have a significant impact, but there's no change to our modeling approach that we showed in the preview video. Then there's a couple of other important things to point out, which was on the conference call. If we scroll down to where we get to the section on the charges, this is going to be the non-GAAP items, so it's the pre-1972 sound recording settlement charges. Well, we know it's 90 million because they disclosed that, so we'll search for that. Okay, so this is where they give the details of how they're accounting for that 90 million. They're taking the one-time charge of $57.9 million in content costs for the current quarter, and then the remainder will be spread out through 2016. But they did give guidance saying that 7.3 million of that will come in the fourth quarter of this year. So if you see in our model, what we did is we took the current charge in the current quarter, the 7.3 in the fourth quarter, and then we spread out the remainder evenly over the next 4 quarters. So our total charge for the pre-1972 recordings is 90 million. Okay. Now let's go back to their guidance on the adjusted EBITDA, because this is going to be how we get back to our total gross margin. So one thing they did note on the conference call is that they expect the content cost to increase by $10.7 million over what their previous forecast was. Now, their previous forecast would have been probably based on a percentage of revenue estimate, and that revenue base is now lower, so it's difficult. You can't just add $10.7 million to that number. But what we did was, since we had all the other guidance put into the model, we were able to solve for the gross margin that brought us to the midpoint of their adjusted EBITDA guidance. So they guided adjusted EBITDA between $25 and $30 million, and we changed the gross margin such that the final adjusted EBITDA number would be 27.5. And you know it's going to be a significant loss, because if they guided total adjusted EBITDA to 27.5 and they're adjusting depreciation and stock-based comp for 38 million, that's well below the 38 million point as is, so the loss has to be pretty wide. And they already gave us the 7.3 million for the pre-1972 sound recording settlement. So then that's all the guidance that management gave us for this quarter. But then there's a few questions as to what we should do for the future periods. So one thing that we typically do, since we don't really know what the street is going to come back with in regards to revenue, is we kept the revenue growth rates quarter over quarter consistent with what the growth rates were prior to this release. And that might be a little aggressive, because the street might come back and adjust their revenue numbers downward after the miss this quarter. But still, it's the only basis that we have for revenue for right now. So once we do that, we went down to gross margin and we said, okay, we know that because their new publishing strategy that impacted the gross margin in this quarter, we know gross margin is going to be lower than what we had previously projected. So we brought it down by about 1 percentage point in each of the next 4 quarters. So once we did that, we plugged in those assumptions, we can take a look now and we can see that the EPS based on management's guidance is expected to be about 6 cents per share. And again, we don't know exactly what the provisions for tax are going to be or the other income, but those 2 items are so small that you can pretty much expect that the consensus estimate is going to be close to 6 cents per share for the next quarter after the analysts have updated their models, because there's not too many variables there. And then the share price goes down. If you look at it on a 50-50 weighting, next 12-month price earnings target and discounted cash flow basis, share prices come down to $15. So it looks like that 20% move in after hours does make sense given the new guidance and given the results for this quarter. So that's all. Be sure to check back in a few days after the analysts have updated their models. We'll go ahead and recalibrate this to meet that consensus estimate. And thanks for watching.